Okay, everyone, let's dive right in. Today, we are going to tackle a subject that, on the surface, might seem a little straightforward. What does a company actually do on its books when it gets rid of an old piece of equipment? Now, I know what you might be thinking. Disposing of assets. It sounds a little dry, right? But what if I told you that this single accounting entry can be like a window into a company's soul? That it can reveal some incredible insights about its strategy, its forecasting ability, and maybe even how well it's being managed. So stick with me, because today we're not just learning the mechanics of bookkeeping, we're learning how to read the story that's hidden behind the numbers.
So let's put you in the hot seat for a moment. Imagine you're the chief financial officer of a major corporation. You've just overseen the sale of an entire fleet of delivery trucks for, let's say, millions of dollars. What happens next isn't just about filing paperwork. The way you record that single transaction, the gain or the loss you report, has a direct, measurable impact on your company's income statement. It can absolutely influence how investors see your company, and it might even nudge your stock price. So you see, this isn't just about cleaning up the books. It's a critical moment of financial reporting that every single one of you, as future business leaders, needs to understand inside and out.
You know, every single asset a company owns is kind of like a character in a story. It has a beginning, the day it was purchased. It has a middle, its years of productive service where it's out there helping the company generate revenue. And then it has an end. Today, we're zeroing in on that final act, the disposal. This is the moment that character exits the stage, and we, as the accountants, the financial storytellers, have to formally close their book and account for their departure.
All right, let's break this definition down, because in accounting, every single word matters. We call them plant assets. First, they're long-term, which means we expect them to stick around and be useful for more than 1 year. Second, they're tangible. You can physically reach out and touch them. But here's the crucial part, the detail that changes everything, is the third point. They are used in operations to generate income. Think of it this way. A delivery truck is a plant asset for a company like FedEx, but that very same truck sitting on a Ford dealership's lot is inventory. The only difference is the intended use, and that distinction is absolutely fundamental to all of accounting.
So, before an asset can make its grand exit, we have to know its official value. And I'm not talking about what it's worth on Craigslist. I'm talking about its value on our company's books. This concept is called book value, and it is absolutely critical. Now, let me be very clear, because this is a concept that trips up so many students. If you don't fully grasp book value, the rest of this is simply not going to make sense. It's the foundation for everything we're about to do.
To get to book value, we first have to understand its partner concept, accumulated depreciation. Let's say we buy a machine for $100,000. Well, it doesn't just help us for 1 year. We plan to use it for maybe 10 years. The matching principle in accounting, a core concept, demands that we match the cost of that machine to the revenues it helps us create over those 10 years. So we expense a piece of its cost each year. Accumulated depreciation is simply the running total of that expense over time. Think of it like the odometer on a car. It tells you how much the car has been used, but it doesn't tell you what the car is worth today.
And that brings us right here to the main event. Book value is simply the original cost of the asset minus that running total of wear and tear, the accumulated depreciation. And here's the most common mistake I see students make, so please listen closely. Book value is not market value. It is a historical accounting number. It's an artifact of our past decisions. You could have a building in downtown Manhattan that you bought 60 years ago. Its book value on your balance sheet might be $1, but its market value could easily be $10 million. That massive gap between the accounting value and the real-world value is precisely why gains and losses on sales exist.
So, the day has finally come. We've sold the asset. Now, it is time for some financial hygiene. The balance sheet must be a perfect, up-to-the-minute reflection of what the company owns and owes right now. An asset that's gone can't be allowed to linger on the books. Think of it like this. When an actor's character is written out of a TV show, you have to remove their name from the opening credits. It's the same idea here. We have to scrub the asset from the balance sheet.
This goes to the very heart of double-entry accounting, the fundamental equation, assets equal liabilities plus equity must always remain in balance. It's not optional. We can't just delete the asset and call it a day. For instance, if you sell a truck for $10,000 cash, you can't just add $10,000 to your cash account. You also have to subtract the truck from your asset accounts. We need a formal journal entry that perfectly accounts for every piece of this transaction, the cash we received, the removal of the asset's original cost, and, just as importantly, the removal of its entire history of depreciation.
Let's walk through the mechanics of this together. Think of it visually. First, we credit the plant asset account for its original cost. This is like formally escorting the character off the stage.
Poof, its original value is now gone from our records. Then, we have to debit the accumulated depreciation account for its total balance. This is like going into the archives and wiping the entire history of that character's performance. Now its past is gone too. With those two moves, the asset has effectively vanished from our financial statements without a trace.
Okay, with the asset now officially off our books, we reach the climax of this whole transaction. This is the moment of truth. This is where we find out if selling that asset was a financially savvy move or a costly mistake. And the number we calculate here, it doesn't just sit in some dusty ledger. It flows directly to the income statement and actually alters the company's reported profit for the entire period.
At the end of the day, this is the bottom line question for any manager, right? I mean, imagine you're selling your old car. You have a price in your head that you think it's worth, and your goal is to get the best deal possible. It's the exact same principle for a company selling a massive piece of machinery. They want a good return. The answer to this question tells us not just about this one deal, but it can also provide some fascinating clues about the company's past decisions.
The entire calculation, everything we've been building towards, hinges on this one simple comparison. Let's picture a balancing scale. On one side, we place the sale price, the cold, hard cash the buyer handed us. That's a real-world, market-driven value. On the other side of the scale, we place the book value, that historical, accounting-determined value we just talked about. Whichever side of the scale is heavier tells us instantly if we have a gain or if we have a loss.
And there you have it, folks, the two possible outcomes of our little financial drama. In this corner, weighing in with a sale price that is greater than the book value, we have a gain. And in the other corner, with a sale price that comes in lower than the book value, we have a loss. It's a very straightforward comparison, but as we're about to see, the implications of each outcome are pretty significant.
So, what is a gain, really? Well, fundamentally, it means our accounting estimates were a little too pessimistic. We depreciated the asset on paper faster than its value declined in the real world. Now, here's a twist that smart financial analysts always look for. It might sound strange, but a consistent pattern of large gains can actually be a sign of questionable accounting. It could mean the company was intentionally over-depreciating its assets, which would understate their income in previous years, only to give them a nice little boost when they sell the asset now. It can be a form of earnings management.
On the flip side, a loss means our book value was too high. Our original accounting estimates were too optimistic. We've all been there, right? You buy the latest and greatest smartphone, and just a few months later, a newer, better model comes out. Your old phone is suddenly worth a lot less than you thought. That's a loss. For a company, maybe the asset became obsolete faster than they predicted, or perhaps it was damaged. Whatever the reason, that loss hits the income statement and directly reduces the company's profit.
All right, that's enough theory. Let's get our hands dirty with a concrete example. Let's say our company has an old delivery truck that's seen better days. We originally bought it for $30,000, and over the years, our odometer of accumulated depreciation now reads $25,000. That means, as of today, its official book value is $5,000. That's our starting line.
Okay, so we put the truck up for sale, we find a buyer, and after a little negotiation, they agree to pay us $7,000 cash for it. So, what do you think? Is this a good outcome for the company? As you can see pretty clearly here, the cash we're getting, $7,000, is quite a bit higher than the truck's value on our books, which was only $5,000.
The calculation is as simple as it looks. $7,000 in cash received minus the $5,000 book value we're giving up equals a $2,000 gain on sale. That's a $2,000 gain. And that $2,000 goes straight to the company's bottom line as other income, increasing its overall profit for the period. A clear win.
But what if the story had a different ending? What if we couldn't find a buyer willing to pay that much? Let's rewind and change the scenario. Same truck, same $5,000 book value. But this time, maybe due to a tough market, the absolute best offer we can get is only $4,000. Now, as you can see, the situation is completely flipped. The sale price is lower than the book value.
And the math is just as straightforward. The $4,000 in cash we received is less than the $5,000 book value we had to remove from our records. The result is a $1,000 loss on sale. And that's a $1,000 hit. It's $1,000 the company will never see again, and it will directly reduce the net income reported to its shareholders.
So we've gone through the mechanics, we've recorded the transaction, and the books are balanced. But as future business leaders, you have to ask the most important question of all. So what? What does all this actually mean? What's the story these numbers are telling us? Because a single gain or a single loss might just be noise, but a pattern of them, year after year after year, that tells a very compelling story.
Now, this is where we move from being a bookkeeper to being a financial analyst. Imagine you're an investor, and you're digging through a company's financial reports. You notice that they have a consistent history of reporting large gains on asset sales every single year. What does that tell you? Does it just mean they're brilliant at selling old equipment? Or could it mean they're playing games with their accounting, maybe aggressively depreciating assets to lower their taxable income in prior years, only to get a nice planned gain later on? It gives you a real window into the quality and the aggressiveness of management's judgments.
And I'll leave you with this final, crucial question to think about. The next time you analyze a company and you see a line item for a gain or loss on an asset sale, don't just gloss over it. Ask yourself, what is the real story here? Are they good negotiators? Are their assets simply lasting longer than expected? Or are they systematically underestimating the useful lives of their assets as a way to manage their earnings over time? As you can see, what starts as a simple, everyday transaction can open up a complex and fascinating line of inquiry. And that, right there, is the power of knowing how to read the story behind the numbers.